Yesterday, the euro suffered heavy losses against the US dollar. It failed to break above the April high, but faced a major sell-off weighed down by strong data on US new home sales. The indicator surged by 9.6% in March, which enabled the greenback to recoup early losses. As for the British pound, their situation was similar. As a result, the pound-dollar pair remained range-bound. Before we get into technical analysis, let's take a look at today's macroeconomic calendar. It includes statistics on German consumer sentiment, which is forecast to pick up in May. Traders may also take notice of speeches by ECB officials. Given that there are no more reports from the euro area scheduled for today, the European currency has every chance of recovering some lost ground. The UK is set to report data on labor productivity. However, this news is unlikely to have a severe impact on market sentiment. Thus, the pound sterling may also enter an upward correction. In the second half of the day, one should pay attention to US core durable goods orders. Economists predict a 0.2% decline in March. Furthermore, the United States will release data on the goods trade balance and retail inventories excluding autos. Although these reports are usually not of great interest to traders, they may still incline market participants to buy the greenback. In this case, both the euro and the British pound will extend losses. Moreover, given that April is coming to an end, one cannot rule out a continued bearish correction after such a strong bullish run. From a technical point of view, the euro-American dollar trading chart shows that it is worth focusing on the level of 1.1002. A false breakout at this mark will create a strong sell signal, thus dragging the euro down to 1.0970. If the price breaks through this level and tests it from the bottom up, the euro will dive to 1.0941 and probably 1.0913. At the mark of 1.0913, I recommend going long on a rebound, counting on a rise of 25-30 pips. Long positions at 1.0970 and 1.0941 can be considered only amid a false breakout. Alternatively, if bears fail to gain control of 1.1002, the euro will most likely enter an upward correction to 1.1029. At this level, it would be a wise decision to go short on a rebound in the hope of a slide of 20-25 pips. Speaking of the British currency, going short positions will be relevant amid a false breakout at 1.2439 or on a rebound at 1.2470 with a view to an intraday correction of 20-25 pips. If the price breaks below 1.2411 by midday and tests this level from the bottom up, the volume of short positions will increase. In this case, the pound sterling will most likely sink to this week's low of 1.2383 and even 1.2353. At the level of 1.2353, traders are recommended to go long on a rebound, trying to catch an intraday correction of 25-30 pips. Long positions at 1.2411 and 1.2383 can be opened only in the event of a false breakout. Best of luck!